Stocks mostly higher after fresh inflation data came in cooler than expected today. Tech stocks trying to rebound after dragging on the major averages in the last few trading days. Joining me now, we've got Scott Leidner, who is the Horizon Investments Chief Investment Officer. Great to have you here. You're warning investors not to get trapped into the idea that a strong economy will lead to a bad stock market. Break that down for us.
Yeah, look, first, thanks for having me on, Brad. Appreciate it. Look, the last month or so, really, when we've had, rates trending higher overall, people, it seems like are getting kind of in the realm or in their head that we're going back into 2022 when we got bonds, like basically rates going up or bond market selling off and stock market selling off at the same time, basically on the back of inflation fears. And I think people are misinterpreting what is driving the primary driver of these higher rates. The primary driver of these higher rates we've seen over the last month is not inflation worries. It is not inflationary types of things. It is growth, nominal growth being sort of re-rated higher. And that type of environment is not one where stocks generally do poorly. I think people are freaking out a little bit because they're reminded of the recent history of 2022 and sort of the bloodbath in both asset classes that we saw. But this setup in 2025 is just not that 22 setup. And I don't want people to get fooled by it.
You say it's not smart to completely ignore non-U.S. equities this year. Why is that?
Again, Larry was talking about some history lessons with you just previously. I mean, this one is the same kind of thing, really. I mean, it's just sort of a call out that year one of Trump won. In 2017, the consensus everywhere in the universe, in the investment universe, was you got to overweight U.S. stocks because of deregulations and taxes, and tariff pressure on outside. So you definitely want to be overweight U.S. versus, say, Europe or Japan. And you certainly want to be overweight U.S. against a place like China or more emerging markets because of what Trump's going to do tariff-wise to them. And that was it was broad consensus in 2017. And then you turn the page and you see what happened in 2017. And Europe international has outperformed the U.S. by about 6%. Emerging markets outperformed the U.S. by 15%. And all the while the dollar sort of cratered during the year 2017. And so, it's really just to harken back to say, listen, let's not be fooled twice by the same sort of phenomenon. This year coming into, year one of Trump 2. It's the same kind of call. Everybody says you got to be overweight the U.S. You definitely have to avoid China and emerging markets because of what Trump's going to do. I just don't want to be fooled by the same thing twice. And so, while the setup's not identical, and there's certainly more challenges abroad than there, this time than in Trump 1. It's not smart to say, listen, it's a fait accompli that the U.S. has outperformed everything this year because everybody's sort of on board that train right now.
When you think about and since we're talking about the transition that is set to come forth here within the White House at 1600 Pennsylvania, one of the massive things that we're thinking about as well is the sectors that are set to perform better under the incoming Trump administrations and which sectors might underperform. How are you weighing that?
Yeah, I mean, like Larry, we definitely like technology. Listen, this is the mid '90s. Like the best comparison right now is the mid '90s. In the mid '90s, we saw that the internet and PC revolution come through that fundamentally changed the productivity outlook for the U.S. and for the world. The AI is him. It's the same thing. This is happening right now. And so technology, you have to be part of it. You can't be underweight tech coming in for the next several years at least. But outside of that sort of more obvious and kind of medium term play, we do like financials here for the first time, frankly, years. Trump obviously brings with him a deregulatory sort of mindset. Deregulation is just what the doctor ordered for financials, both large and small. So we think it's going to be more of a consolidation story in the financial space. So we prefer the smaller financials to the larger ones because we think the larger ones are just going to gobble up the smaller ones. And so you'll get sort of get that deal premium embedded in there. But that's certainly one that we like. As far as things we don't like particularly right now, consumer staples is top of the list. Look, for consumer staples to work, think your Pepsis and your Colgates and things that are just consumer staple wise, you got to have one or two things happen. You either have to have inflation or you got to have a recession, and we got neither of those right now. So we don't think you lose money in staples, but it's certainly not going to keep up in what we think is going to be a pretty reasonably good market in 2025. And then the more surprising one that people sort of scratch their head at when they think Trump, people generally think drill, baby, drill, and so they say, listen, you got to be invested in energy stocks, and because deregulation plus drill, baby, drill is going to be really good for those names. And historically, it's not really. The deregulation part's fine, but baby drill is not constructive towards the price of the underlying commodity. Actually, it helps depress the price of oil, which is good for the consumer and good for the economy, but not necessarily good for the equity value of things like Exxon and Chevron and sort of the big major integrateds. And so that the energy sector is one that we're not really in love with right now either.
Scott, thanks so much for taking the time here with us today. Good to see you.
Hey, thanks.